Good day, guys. Welcome to Forex Walker. Welcome to episode 79. Now, on this episode, we are going to be talking about the things that you don't like. We're going to be talking about the fundamentals. Now, the currencies that I usually say trading fundamentals is not really that difficult. You can just look into trading monetary policies, looking for monetary policy divergence. And here we have the NZD, the New Zealand dollar, and this was November the 25th. So here the RBNZ, the Reserve Bank of New Zealand, says previously here, let me remove this, don't want it to disturb. Here we have 2.5% in interest rates. Now these interest rates here, we have 2.5% previously, right here, and they're talking about a consensus. Normally, I look into the forecast, the one on the far right. The forecast says from 2.5%, they're expecting a 2.25%. That means they are forecasting an interest rate cut of 25 basis points from 2.5. So what I normally do is that I look into another future. Here we're cutting interest rates. Normally, a monetary policy divergence is when another currency hikes interest rates and the other cuts interest rates. But right now, we have globalization and markets do not move independently. That means all economies go into the recession mostly at the same time, even though they don't start cutting interest rates at the same time, but they all go into a recession and they all depart from a recession in almost the same time. Some currencies might go into a recession a year before the other, and another currency will might take it might take a year to actually get into the recession, just like what the pound has done. It just into a recession this year, and the euro went into the recession last year in 2024. So here we are forecasting from 2.5%, we're forecasting an interest rate cut of 2.25% on the New Zealand dollar. Now, when they introduce an interest rate cut, we're expecting the hedge funds to rush to sell the currency. That's what we're expecting. And it does not really move because of market fundamentals. It moves because the hedge funds are going to rush to sell the currency, or perhaps I should say they will uh, place this currency into a short portfolio and the other currencies on a long portfolio, and they'll decide to match the currencies with other currencies that are holding interest rates. Now, that was the New Zealand dollar on the 25th of November. Let's move into the month of December. Here we have all of those speeches, chart pack from the Reserve Bank of Australia, talking about whatever they're talking about. So here it says, let's look into the date. It says December the 8th. And what happened? Previously we had 3.6%, and they were forecasting at 3.6%, which is the same as that of the previous. That means they are most likely to hold interest rates in the Australian dollar. So you can actually plan for this monetary policy divergence ahead of time. So what happens is that the Australian dollar holds interest rates. That is a bullish signal. Remember, a bullish signal is when a currency holds interest rates or when it hikes interest rates. And a bearish signal is when a currency cuts interest rates. So let's just put it that way. So we have an NZD that is looking forward, that decided to cut interest rates. And we have the AUD who says, nah, I'm not cutting interest rates, I'm holding. So you can actually take an AUD NZD long. So let's look into the currencies and see what we can do with this currency. Oh man. Okay. So this is AUDNZD, and what does it tell you? When we look into price action, okay, let me go into the daily time frame. When we look into price action, you can see that this currency has been bullish for a lot. This currency pair has been bullish for a long time, the AUD NZD. So the Australian dollar was out competing the New Zealand dollar over time, even though the New Zealand dollar went into the recession ahead of the AUD. That tells you that the Australian dollar was doing well. We can compare the Australian dollar with the pound, who also went into an interest rate cutting cycle much later compared to the euro. So here, when you look into price action, you can see that this whole market is overbought. But, but when you have context being a monetary policy divergence in this trade, you can actually see that. Let me show you the previous shoulder here. Let's go to the 4 hour time frame. Just want to show you the previous shoulder, how we got to find this is the previous shoulder here. Let me zoom it. This is the previous shoulder here where we got this purple line, and we went to the 50% feed. We came back to an entry level where we entered the market, and the market rallied, and we're expecting this rally to continue based on monetary policy divergence by the hedge funds, the mutual funds, all kinds of banks. We're expecting them to buy this currency. So trading market fundamentals is not really that difficult. The only difference here is that you, with my broker being XM for this broadcasting, for this YouTube channel, I'll be paying a swap of negative 3.32 points per night. So that means I will be sharing my profits with the broker. That's the reason why you have a swap. Sometimes we take a positive swap. You can actually take a positive swap by introducing something like the CHF. I don't want to take that much long. You can actually look into the CHF where I was long for quite a while, and you can go long on the only difference is that I have not looked into the CHF that much, but I do know that the CHF is actually at 0% interest rates, and they're about to jump into the negatives, but they don't want to do that, so they will have to print money to save their economy, and that CHF is actually in trouble. So most of my currencies have the CHF as a short currency, and you can also replace it with the JPY, which is not doing that well. And the JPY will also collapse the same way that the CHF is collapsing. So these are the longs that I've been looking at for some time, and they will continue to move in that general direction. Let me look into the Euro AUD. We've been talking about this trade on the previous episodes. I was expecting the market to jump into the previous shoulder here, uh, perhaps in the middle of these previous shoulders, or just one previous shoulder and reverse. But because the economic divergence was huge, this happened. But now we have an issue with the euro. The euro was is selling because it was overboard, but the euro held interest rates, so it would be much better to take the AUD instead of the Euro AUD. Nonetheless, the trade does not really fight back that much. So from the entry, you can see that you might as well have entered here or here, but you can see that the 23.6, the green line, held, and we're expecting to cross below this 50% fee. Let me show you things that I'm talking about. This is 23.6. This is the 50% fee. I normally talk only about these, but when I move into silver, I talk about the 38.2 and the 23.6. So that's just how I trade silver. And this trade will have to break below the 50% fee before I decide to move my stops to break even. And somewhere, I'm expecting the market to actually land here or perhaps give us a manipulation, which would be the third touch, first touch, second touch, third touch manipulating. So those are my current expectations in this currency. Let's look into other trades. Another trade can be taken on the AUD CAD. However, I'm a little bit reticent with the CAD as they held interest rates. Perhaps in the subsequent future, we might look to cut interest rate. They might look to cut interest rates, but so far I'm seeing the CAD as being a currency that is exiting the recession. So it might as well be uh, a better option to choose the CHF and the AZ and the NZD as the replacements of the cat. However, here in price action, you can see that this is the 4 hour time frame. We have the previous shoulder here. There's the previous shoulder. That's why I went to the 4 hour time frame. And you can see that the cat landed nicely on that. And we actually took off from this is the daily. We actually took off from where we reversed. Nonetheless, I'm not really focusing that much in this trade. I told you on the previous episodes that uh, this market is overbought. In the law of price action, you can see that this market is at the highest level. This is the lowest level, and I'm telling you that to take longs at an overbought area. Some people call it a breakout. I don't trade breakouts, but this is a point where someone would be looking to sell, especially after the market manipulated this level. They might be looking to sell, but I'm looking into context, and I have a good hold in interest rates on the AUD and the same on the CAD. But the CAD being a weaker currency, I'm expecting it to actually allow this trade to proceed in this move with the AUD. But at the same time, you have to remember that uh, the CAD held interest rates. If they introduce interest rate cuts in December, then we might be talking about a break even higher. Thank you guys for this episode of Monetary Policy Divergence. I will see you on the next episode. Goodbye. Or perhaps I might see you next year. Goodbye, guys. Merry Christmas.